Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, for listening each and every week. You know, if you want to see the show, we tape this show for YouTube on a daily, weekly, monthly, yearly. We've been doing it for about 8 or 9 years. And if you go to Jeff Barton, the Mortgage Voice on YouTube, you can see this week's show as well as an archive of years and years worth of shows. One of the interesting things about that is you get to see trends about what's happening over the past 5 or 6, 7 years, or the last quarter, just to see where we were and where we are now. As everybody knows, a year ago, the mortgage market was quite a different story. And today, of course, with the bank failures that we've had from last weekend, it's really changing environment in the lending business. We were looking at what was happening with inflation out there in the big world, running at about 6.5%, and this new the new CPI numbers kind of bear that out. And we were talking about the Fed raising the short-term interest rates by 50 basis points, maybe even more. I mean, we had been trending at 25 basis points after last summer's 75 basis points clip, 3 Federal Open Market Committee meetings in a row. And then we're getting down to, okay, we're going to be cutting it. It's going to be lower. We're getting inflation under control. Well, the last inflation report really had the inflation running hot. So it was like, okay, we're going to get aggressive again. We're going to maybe 50 basis points. We're going to try to really crush that inflation, because that was the big economic news points, things that people were worried about. And it affected the stock market, and it affected people's 401ks and certainly your credit card and a lot of other things that it would be affecting if, in fact, we were going to 25 basis points. But to 50 basis points, that would affect quite a bit more. Well, what a difference, right? So we have the failing of 2 of the largest banks in the U.S., 2 of the largest failures of banks ever. The biggest failure was back in 2008 of Washington Mutual. Everybody knows Washington Mutual. I had an account at Washington Mutual. I dare say there were many, many people that had. But that's like ancient history right now, 2008. Come on. That was a long time ago. Well, over the weekend, the Silicon Valley Bank, they went down. And one of the reasons they went down, I don't want to talk about it, just because not only is it interesting, but it also, you have to pay attention, because you then have to worry, okay, what about my bank? Is my bank okay? And what do you mean by that? And how do banks really make money? And what is the safety net around most banks? Most depository institutions, Chase, Wells Fargo, Bank of America, my particular bank, which is Union Bank, here in California, which was purchased and then purchased again. So I think they're currently U.S. Bank. They are solvent, or what they call they exist because people put money in their accounts. They're depository institutions, like Silicon Valley Bank. Silicon Valley Bank was a very large institutional depository bank, meaning that other banks, other businesses, large companies use those banks, put their money. That's what you do with a bank, right? I mean, whether you watch old movies and you see I guess this would be back in the old Western town. We're kind of Western out here. You'd ride up on your horse, you deposit your gold nuggets, and they'd be safe in the bank. And, and everybody would be very sure that their money, their deposits, and everything that they put in there was in good hands, was safe, couldn't be stolen. Well, that's kind of how I feel about a lot of people when they think about banks. We all use them. We all use them on a daily basis. Whether you do deposits and withdrawals on a daily basis, that money that is deposited in that bank actually makes that bank strong. And that bank being strong allows that bank to go out and lend money to other people. However, Before Dodd-Frank, which were the regulations that came out after 2008, Dodd-Frank, those are two guys, Chris Dodd and Barney Frank. They were both representatives in our National Congress, and they set about, along with Elizabeth Warren and a bunch of other people, to regulate the banks. One of the things that they made the banks do was to keep more money in the bank to make sure that the liquidity, the cash on hand, could cover a shortfall or a run on the bank. What is a run on the bank? That's when everybody who has money in the bank decides to take it out on the same day. That's a run on the bank. It's what happened during the Great Depression, what happened in 08, 09, what happened to Lehman Brothers back in the day in 08, 09. So this particular banks, what happened to them and how does it affect you? Let's talk just quickly. I'll just run through it quickly. So Silicon Valley Bank, which is right here in California, by the way. Silicon Valley Bank was the bank to the tech sector up in, obviously with a name like Silicon Valley, you figured that's what they're doing, right? They're taking large deposits from many tech companies and lending money to many tech companies. And what they would end up doing with the deposits, especially in the low interest rate environment of the last 10 years, a year and 2 months ago, you could borrow, if you owned a bank, at the rate of 10 to 1 at a quarter point per year. It's currently almost 5% per year, and that's in 1 year. That particular interest rate that they charge has gone up, 500-600%. So if you're a bank and you can borrow money at one number and invest it in treasury bonds at another number, and there's a spread, which is, it had been 3-4%, you're making pretty good money, right? And that was the chain of events which led to overextension of that kind of borrowing and purchasing. For instance, it's great when the interest rate is a quarter point and you're borrowing it and then buying treasuries at 3 or 4%. It's great when that happens. But when the borrowing rate is 4% and the treasuries do not keep up with that particular investment, meaning you've already got a 2 or 4 or 5 or a 10-year investment in bonds that pay you X% per year, and the borrowing cost just went up through the roof, that model of making money goes away fast. And given that, the liquidity that the bank needed in order to remain solvent, there are those thresholds that Dodd-Frank made you maintain. You have to maintain X amount. I don't know what the percentage is, 5%, 2%, 3%, 8%. But if you're talking in billions and billions of dollars, that's a lot of money you got to have on hand. They didn't have it. And when they didn't have it, they had to also, many of the depositors in that particular bank decided to take their money out because bad news travels and bad financial news travels really quickly. Large institutional investors decided to take, $160 billion out of the bank in one day. The next day, the feds came in, that's last Friday, and took the bank over. That's how quickly this goes. One of the problems with the internet, one of the problems with the way trades are being done, one of the problems with information is that it is so lightning quick that these kind of failures, this was the second largest failure in U.S. history. Incredible. Really, really incredible. Could it have been avoided? Who's to blame? Well, that's a Washington political scheme. The question is, the federal government has stepped in and said, we will cover all deposits. Anybody who put their money in there will be covered. Now, how many individual investors have their money in there? How much does that equal, and who are they? Because everybody's insured up to $250,000. That's what the FDIC does. But anything over and beyond that, the federal government, Joe Biden, stepped up because Joe Biden is, again, a corporate politician like all of them are. They all receive money from both sides of whoever is, whether it's the electric companies, the oil companies, whoever it is that's giving out money, they give it to everybody. So in the banking world, making sure depositors aren't nervous is a big deal. Because if they're nervous at Silicon Valley Bank, they're going to be nervous at Bank of America. Anyway, I'm Jeff Barton, your voice in the mortgage industry. I hope that was clear enough. Anyway, I think we're okay for right now. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show. If you want to see this show, go to YouTube, Jeff Barton, the Mortgage Voice on YouTube. We've been there for a number of years. You know, we also do a weekly, we try to get it on Facebook and Instagram and a number of other social media channels. It really just brings to you directly what we do on a weekly basis for the show, which is provide information about mortgages, about real estate, and about what's happening in the economy, which may affect your particular decisions. We had mentioned earlier podcast.io, and that's a great place to catch me as well as a number of other podcasters. That's a central location for podcasters on health and finance, lifestyle, sports, a whole bunch of different things. So if you want to see and hear me, Jeff Barton, the Mortgage Voice on YouTube, or if you can go to podclips.io, that's a great place to catch me and a number of other great new podcasters. Okay, joining us from Vallejo. I believe it's Vallejo. Is that right, Darren?
Just moved from Vallejo to Nevada City, Cascade Shores.
Okay, excellent. This is Darren Woodworth from Malibu Funding. Very snowy, very, I don't know if it's cold. Is it cold up there?
Right now it's raining and it's about 45 degrees. We've got about a foot of snow on the ground that is melting.
Oh, man, so you have just water incarnate. It must be really tough up there to drive around.
Well, we were out of power for 9 days, so we're living the dream with power right now, so we're good.
That's okay. So here in sunny Southern California, try to tell our listeners, now we're drenched down here today as well, and it's been raining kind of steadily for the last 2 or 3 months. But in a situation like that, which, again, we don't know much about at this particular point, what's it like living in electric-free zone?
It was good until my generator stopped working and I burnt my last piece of firewood, so we went back down to the flatlands of Vallejo. We're flatlanders, so
right.
First winter up here, it was kind of, we were not prepared for this deluge of snow that we got.
Now, it's interesting, right? I mean, as you are, I guess you would call yourself sort of a new homeowner up there. Now, you've represented many homeowners, many sellers, many buyers over the years. What's it like being on the side of moving into a place either you bought or you're renting for a first time? What's that like?
It was exciting, and then once the snow started falling, we kind of put in the gear of survival and get the generator, get the firewood, and all that stuff. So, very exciting. We're 5 minutes away from Cascade Shores,
right.
Scotts Flat Reservoir, so I could walk down to the lake. And so this is just a little hiccup. It's been a couple weeks of snow, but it's hopefully it's going to be gone here in the rain.
Okay, let's talk about doing some business in these type of conditions. Does it just stop altogether, or do you continue to work on your loans or the customers for mortgages and real estate that you have? How does it work like that?
Yeah, it's 24/7 real estate.
Right.
It is. So keep going, moving forward. I got a couple buyers that were on the sidelines. They thought COVID was going to drop prices, so what they did was instead of buying, they went out and rented.
Right.
And now they're questioning their, 3 years later, they're like, I need to buy now. So they're back in the market. So I got a couple buyers like that right now that I'm working with.
Okay, tell us about the area that you work in. Obviously, you've described a little bit about where it is, and what is the real estate market doing up there? I know some parts of California, it's a little challenging, and some other parts, prices keep rising. How is it up there?
Grass Valley, Nevada City is still moving forward. Not too many prices are dropping. They're still selling for list price. Vallejo is pretty similar. It's the last affordable city on the bay.
Right.
So it is still getting, there's no drops in prices too much.
Okay, what are the prices? Give me some medium prices, high prices, low prices.
So my buyer is qualified for 475, so he's looking for a 3.2 or a 4.2.
Uh-huh.
And he's willing to add a bedroom onto a garage. So he's got his mother-in-law moving in and his mom's moving in. So he's taking care of two mamas. So he's going from renter to homeowner / ADU, build a garage into an ADU. So that's where he's at right now.
Do you think the equity in homes is going to continue to rise? I know you told me that the prices are still rising a little bit. But we see anywhere from, 2 or 3% all the way up to 6-7% in terms of rising prices this year. Is it like that there?
Absolutely. It's there's just supply and demand.
Right.
People are moving. So I'm originally from Napa, but I moved to San Jose, so Silicon Valley. So SVB, the bank, Silicon Valley Bank.
Yep.
I'm very familiar with that and everyone out there because I lived there for 22 years.
Right.
People are taking their San Jose homes and they're selling them, and they're moving up to places like this, Grass Valley, Nevada City. I mean, you could buy all cash, and then just changing the way they do business. You're working from home.
Yep.
Not going to the office. So.
Is that really changed the nature of housing in your area? I mean, like you say, you're in a hot area because you have to be there because the commute is too long if you live somewhere else. But if you can work remotely, all of a sudden you're selling and buying cash other places where might not have been available a couple, 3 years before the pandemic.
Absolutely. I'm local, so I mean, I could go get in my car. I'm 2 hours away from Vallejo, so I'm showing properties the next couple days in Vallejo. Everything's all lined up. I do all my loans here in Nevada City, so it's pretty localized.
And
I mean, two hour drive for me is, once or twice a week. That's not that bad. So
you're still in this, even in the weather conditions that you've been talking about. You're still out there. You're showing houses. What's the enthusiasm like? Are people sort of worn out by the weather, or are they still, as you say, excited about getting out there and viewing properties?
Oh, out here it's amazing. All my neighbors came together. You need a shovel. You need a snow blower. I didn't have any of that stuff because I'm new to the winter up here, and it was amazing just to see how much community came together. And the people that are buying up here, they get to witness that. So when you're showing properties, they get to witness the different, how it is in San Jose. It's a little fast-paced. Up here. Everything's a little bit slower, and everybody's, hello, how you doing? And they want to sit and talk, and it's way different.
That's a great lifestyle. That reminds me of things the way they were back when I grew up. And I grew up in a little town, 5,000 people. Everybody knew everybody. Now, granted, this was before electricity, but still, it was a great way to grow up.
Absolutely, loving it. It's paradise up here. Even if I had to drive over power lines and under power poles with trees on them to get out.
Right.
And I'm still, once I got out, I'm like, it's still paradise up here. This is a minor couple days or a week or whatever of inconvenience.
Right.
That is nothing. We're living in paradise.
Oh, that's excellent. Okay, so give me a little bit of a prediction on what you see. Now, we've had such water issues here in Southern California. I guess up there too, right? I mean, you've been under the same drought restrictions that we have?
Yep.
And so
all our reservoirs are filling up. Hopefully they don't open it up and send it to the ocean, and we'll be all right.
Yeah. Well, I was talking a little bit earlier about some of the politics of all the weather and the different things going on. You'd mentioned something about Silicon Valley Bank, and they are, I guess, maybe not getting bailed out, but certainly all the depositors are being covered. How is that affecting the psychology of using them or any other bank up there? I mean, do people get nervous about that, about where their deposits are? And
absolutely. I mean, if your boss is that's where his checks come from, and he's sending you checks that aren't cash, and it's going to be like a little freak show for a little bit. But
yep.
I mean, I've noticed that everything worked its way out. Hopefully, I mean.
Yeah, hopefully they will. I mean, obviously, anybody who's got like you say, a check coming from Silicon Valley Bank, is it good? Is it not good? Are they starting? Because apparently it's already been handed over to federal regulators, and yeah. So I guess that's just something that's going to shake out as a number of other banks look like they're also in trouble.
Yeah.
Yeah. Well, Woody, I appreciate you coming on the show once again. It's always a pleasure. And really stay dry up there, stay warm. Can't wait to get the next report of what's going on up in your area.
I appreciate you. Thank you.
Thank you. Hey, you want to shout out a phone number, a way by which people can get in touch with you in case they need somebody, a great agent up in that area?
Absolutely. Darren Woodworth. My number is 408-425-7845.
Excellent. Thanks, Darren. Thank you very much for coming on the show. I appreciate it.
Absolutely. Have a great day.
And you do too. That's Darren Woodworth from Bridgeport Real Estate. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show each and every week. We come to you, we bring to you solutions, maybe ask some questions, try to observe what's going on around us here in the IE, San Bernardino, Riverside counties. KCAA brings to you our show. Been doing it for about 9 years. Appreciate the work they do there. But the main thing here is, what are the solutions? What can we do? How is it that you're going to be able to take advantage of the information you get from this show? One of the places you can go is to the company website, the station that we, let's see, it's Jeff Barton, what is it? TheMortgageVoice.com. That's the website. If you want to go there, you can see not only the guests on today's show, but you can probably see guests from a number of shows. If you want to contact them directly or at least hear a little bit about what's going on from past shows, you can go there. It's a great place to get your information if you've missed it from the show. That's themortgagevoice.com. Okay, so with us once again, and I'm glad to have her back early in the year because we'll get to compare it to what's going to go on later in the year, is Wendy VanWessel, and that's from Kind. She's from Kind Lending. She joins us now. Wendy, how are you?
I'm just fine, Jeff. And yourself?
I'm good. Thank you very much. I'm a little bit unsure about what's happening in the mortgage industry. We're seeing the rates go back up, and it's just killing us. We were doing well when the rates were in the mid-5s, which I think the market can take. But when we get closer to 7%, it really, really slows things down. How about yourself? What do you see?
You see it across the board because less borrowers qualify with their debt-to-income ratio with the higher rates. So, yeah, it makes it a little bit more difficult for us.
Yeah, it really does. And now I know when we talked off air that you have some solutions, some different ways that you might be able to help some buyers with the programs that you have there. Give us an example or two of what you all are doing in order to help out in this situation.
I think that there's quite a few things that are being done. First of all, the big news out there is if you want to do an FHA loan, the monthly MIP, mortgage insurance premium, has drastically been reduced by 30 basis points or more.
Yep.
And that makes it so that it's cheaper than when you go with a conventional mortgage that's over 80%. It also has to have monthly mortgage insurance premiums, but it's often more expensive until they correct it because the FHA is so much lower. And those rates are still in the mid-5s.
Okay,
So
go on. Sorry.
If you want to finance what they call upfront mortgage fee, which guarantees the loans to the lenders, you can put that into the loan, and then your monthly mortgage insurance premium is lower on an FHA loan, and the rates are still pretty low, so you probably still qualify. And their DTI, debt-to-income ratio on the back end, goes a little higher, too, often.
So the FHA borrower, now you take with Kind Lending FICO scores down to what, 620, 580? Where do you go to?
580.
Okay.
580.
Now, those type of borrowers, when they are coming to you, if they have actually, let's say they're a married couple, one of them has a 580. It used to be that you had to use that particular FICO score in order to qualify because it was, the lowest one. Let's say the spouse has a FICO score in the 700s. Is there any way that you can use both of those FICO scores together?
That's when you flip it to Fannie or Freddie on the conventional side. It would be Fannie.
Okay.
Fannie Mae allows you to blend a ratio. So if you have a borrower with a 560 FICO,
Okay.
and the other borrower has like a 710, they'll blend the ratios so that you would be able to do a loan, because I think that most conventional loans are at the 620 FICO score that you need. You'd still be able to qualify for the loan, although you would get the loan level price adjusters on the lower, well, I think it goes down to 620 on that score, which your middle average score would be allowing you to do the loan with both borrowers, and sometimes you need both borrowers' income.
So FHA
that's
won't do it, right? But a conventional loan will do?
Yeah, Fannie Mae.
Fannie Mae.
Fannie Mae with that one. And then there's also something else called a first-time home buyer.
Okay.
If you are a first-time home buyer and you are 100% of the mean, the average income for the area, or in the high-cost areas, which a lot of LA is, 120% of the mean income, you get zero, that's right, zero loan level price adjusters, so that makes your price much better too. So for the lower FICO, for the higher LTV, all of those loan level price adjusters get wiped out, and you just need to take one class for the first-time home buyers and have the income that you need, and that makes it so it's more affordable as well.
Okay, so in talking about price adjustment, or talking about different ways that you're going to see a different rate on your loan versus somebody else, which is kind of similar but not, because there's some extenuating circumstances, FICO score or amount down, certain other things. When you were explaining that not only to the loan officer, but when the loan officer is explaining to the client, what is the best way by which you can say, hey, look, you're not a great borrower, so you're going to have to pay more? I mean, we that's exactly what it is, but it's a little bit difficult when you're trying to obviously get the only loans that are out there.
I would probably say that loan officers are mostly help the people with the biggest purchase in their lives. So they're a little bit of a financial planner. They try and get them the best loan for where they are at in their credit history. So if you tell them to pay off all their credit cards down to about 30% if they can,
Right.
that raises their FICO score quite a bit, and by the 10th of the next month, you should see the differences in the FICO scores. So how do you say it to them nicely? Stop spending money.
No, that's exactly right. And I think you hit the nail on the head when you came up with a solution. You said, hey, look, you want to try to get your credit cards down to about 30%. What are some of the other ways by which you might be able to get rid of these price adjusters?
Well, your DTI doesn't, well, it's starting to take a hit. If you have a jumbo loan, it does take a hit for the debt-to-income ratio. And I would remind people that if they have a car loan, not a lease, but a loan, and they can pay it to under 10 payments left on the payments that they need to make to pay off the car, then they no longer have to include that in their debt-to-income ratio. So I would say pay off your credit cards, pay them on time.
Right.
What else can you do?
The car loan's a good one, too. Make sure it's less than 10 payments or less. That's pretty good.
Correct. And then you have that car payment that can be taken out of your debt-to-income calculation.
Right.
I like the one for first-time home buyers as long as they're in the mean income area.
Right, that's a good one, too.
I also don't ever, if you've ever served if you've ever been of service to our country, military, say that, because the rates for vets is wonderful. I have something for vets who are never allowed to buy units, and it's so popular, buy units out here and rent the other ones out that not living in. Well, we called Washington, D.C. to get a straight answer, and vets can buy multi-unit properties even if they have no landlord experience, if they get a management company to collect the rents for the first 12 months.
Okay.
And that contract with the management company would be signed at docs. Then they can do that unit purchase, which makes the properties self-sufficient. They give you income as well.
Is that like a DSCR type loan in order to qualify? I know that vets get 100% financing, but what type of program? Is it just a VA loan?
It's just a regular VA loan, because they were always they were unable to buy units if they didn't have the landlord experience that they were talking about.
Right.
So even though they wanted to have that income from the other units, they couldn't do it, but they can if they get that management company first 12 months to collect the rents for them.
Okay, we're on to about a minute and a half left. I want to get your opinion as to where the market might be headed. You have more of a, I guess, feel for it because you're at a lender and Kind Lending, and the people that run your company have been around a long time, and you, like I say, you have your finger on the pulse of it. What do you think's going to happen? Do you think we're looking at a recession? Do you think we're going to be going to a better mortgage rate later on in the year? What is your thought?
Last November, they thought that probably around August or September, they were hoping the rates were going to go down to 5.25 again. And that was good news for everybody. I don't know if it's panned out to be that because we keep having the feds jump in and try and make the rate as high as the inflation rate artificially.
Mm-hmm.
And it's just messing up the works. It's making less properties available to less people. People are staying in their homes. There's not as much inventory on the market because they don't want to have the higher interest rates. But I do believe that they're going to go down. But look at the 10-year bond today. What is it at 3.98? It's pushing 4 now.
Yeah, I know. And you get the 2-year almost a point higher. So short-term and long-term, I mean, it yells recession, but, we're not quite sure. And is recession really a good thing for the real estate market? I'm not sure that is either.
I think that our inflation is going to continue to be high. We still have problems that need to be worked out.
Mm-hmm.
I don't love that the strategic oil is being yanked out to keep the fuel costs artificially lower than they should be because where we're buying it from or what's happening on the global field out there. I just think that the feds need to, they were doing it 0.5 point, raising the rates by 0.5 point, then they went down to 1/4. I hope they don't go back to the 0.5 point raises. I mean, we're going to have loans. We're going to have people that need to refinance. They're at the biggest amount of equity in their homes that they've had in a long, long time. So they can do it. They have to have 12-month seasoning now. That was a new change for a cash-out refi.
Oh, okay. Hey, Wendy, we're up against it. I'm sorry. I ran over here. I'm sorry for
Right.
Really like having you on, and I always like your opinion about things because, like I say, you really know what's going on, and I appreciate it. Thank you for coming back to the show, and we'll get back to you pretty soon.
Okay, my pleasure. Thanks, bye.
Thank you very much. That's Wendy VanWessel from Kind Lending. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in to the show. Each and every week, we bring to you a number of different guests, a number of different people who talk about some of the solutions that we can bring to you. I know that in this kind of market where there's all sorts of unknowns out there, whether it's the rate, whether it's is my bank next, these sort of questions that you're thinking about, especially this week. You know that this particular show, we've been on the air 9 years, and we bring you solutions. Most importantly, though, we bring you people who are in the business, who are doing loans each and every day, or real estate agents who are doing transactions all the time, so we can give you boots on the ground look at exactly some of your options. One of these guys to join us, who's been on the show before, and I appreciate him coming back, Ryan Bagan from 11 Mortgage. Ryan, how are you?
I'm doing fantastic, Jeff, and thanks so much for having me back on the show.
Thank you very much for coming on the show. Okay, so a couple of big banks went down last Friday. It looks like we may see a couple more go down. How's that affecting the marketplace, your particular stability at 11? And, what's your outlook on that particular aspect of what we do?
Well, you know what? There is a little bit of uncertainty. The rates are a little bit high, but we've been preparing for this moment for a long time. We're actually hiring underwriters. We're hiring people from a lot of other banks, a lot of other, people that I know in the industry. They're ops people. They're laying people off. Their ops are only working 6 hours. We're giving these guys overtime. We're hiring new people. So we're actually in a completely different situation or a position than a lot of these other guys.
Right.
Where we have a lot of liquidity because we saw what was going on. We saw the service release premiums. There was a lot of these guys that were just buying the market for a little while there.
Yep, that's right.
Loan Depot, Rocket. We saw what they were doing, and at the end of the day, we're in this business to be profitable. We're not here to do things for free. not to say that our margins are not very, very tight right now, but we didn't put ourselves in a predicament where we weren't going to be, right-sided, right? So you saw a lot of people exit the market. You're starting to see a lot of wholesalers with cracks on the walls. We saw the first quarter earnings or fourth quarter earnings that didn't look too hot for a couple of these guys that did the IPOs.
Yep.
So we're completely, we're ready to rock and roll. We're actually excited for this type of market because the strong will survive and the weak are going to get put to bed, basically.
That's right, and I think a lot of the lenders out there who were working on a different kind of business model rather than just making money from doing loans. Like you say, they're either buying servicing or they're trying to hedge or they're trying to do a number of different things by which either protect themselves or make additional money. Give us an idea of some of the products you think or that you're doing at 11 Mortgage, which are really appealing or solving some of the issues, problems people might be having with obtaining a loan right now.
Well, you know what? It's historically the worst time for a first-time home buyer to get into a property because of the affordability factor. The houses prices have not come down based on the rates where they're at.
Right.
The rates are still high, even though we had a little bit of an improvement when all the bonds got sold, early this week. But you know what? What I'm doing is I'm offering the 3-2-1, the 2-1, the 1-1.
Yep.
Right now, a lot of sellers are actually willing. Before it was, it was highly unlikely, if not impossible, to get seller credit. But you know what? Now I'm seeing a lot of seller credit. So we're doing a lot of the 2-1, 1-1. We're even doing the 3-2-1 on the FHA loan.
Explain that a little bit, because I think a lot of the customers, clients, people who are listening to the show go, what the heck is he talking about? Now, you and I know what I'm talking about, but just explain it a little bit.
Okay, perfect. So a 3-2-1, or let's just use a 2-1 buy down. There's many options. There's a 3-2-1, a 2-1, a 1-1, a 1-0. They're temporary rate buy downs that are seller funded, okay? So basically, long story short, for a 2-1 buy down, for the first year, you're lowering your interest rate by 2%. The second year, you're lowering it by 1%. But the interest is still getting paid. I'm going to use a very generic number here. Let's say a 5% mortgage rate, okay? The first year, you're paying interest on a 3%. The second year, you're paying it on a 4%. And then the third year, you're getting back to the 5%. But the interest rate, the interest is still being paid on that 5%, but it's being paid upfront by the seller. Now, this is great compared to a buy down on a rate, because if you do a buy down, that money is done. Like a discount, that money basically gets paid for whatever day it is. That's how much it costs for you to get that rate. But with a 2-1 buy down, let's say it costs $15,000 for using generic numbers here.
Yep.
If you refinance, let's say that we have a huge improvement in the rates. If you refinance that loan down to 4% before the temporary buy down term is over, that money's not wasted. It actually goes as a principal reduction. So not to mention, is the buyer paying less upfront because, of course, they're going to have additional costs when you're buying a home. You're buying a home. You're going to get a new furniture set. You got to get, there's a lot of other miscellaneous costs. So it makes it a little bit more bearable. And then the total goal would be, of course, to refinance them into a lower rate before that period is up. But, it just gives them a little bit of a jump start, a little bit of lower payment initially, so that it's the affordability factor is a little bit better for the borrower.
Interesting, because and I like the program, and I know there are a number of other lenders like yourselves have gone to offering it. I just like the fact that there is some adaptability, and maybe those sellers which don't see their properties moving as fast as they'd like to can see that there's an option to maintain both the price that they sell it at, but also to be able to help out the borrower, which, in some cases is the way to sell your property, especially in those areas that, aren't seeing the type of equity increase, actually seeing some equity decrease. They want to lock in their gains, and so selling it this way is a way to do it.
I completely agree with you, but it just takes knowledge.
Right.
You need to have an in-tune real estate professional, and you also need to have an in-tune mortgage professional, because you need to be you need to have a buyer's agent that's asking for it, and you need to have a loan officer that's using it to the borrower's advantage.
Yeah, I agree with all that. And when we're talking about mortgages, mortgage rates, and other things that are available in the marketplace, certainly over at 11, where do you see it going? I mean, I've read some things that said it may be going up into the 8s, and then all of a sudden this bank failure happens, and it looks like we may not be having the Fed raise their short-term interest rates, which absolutely affects the bond rates. So it's one of those very strange times where there's no clear indication trend line because I just don't know.
Jeff, if I knew that would mean I would have a crystal ball and I'd be sitting on a beach somewhere drinking a Mai Tai, right?
Yeah.
But I don't know. Before, we used to have things that we could kind of, that would dictate what would happen.
Yeah, the 10-year.
Now the 10-year is, of course, basically all the MBSs are pegged to the 10-year, right?
Right.
But before, there was other things we could look at to kind of gauge where the market was going. But we're kind of in unfamiliar waters here. I don't know, unprecedented, I would say. So at this end of the day, I stopped really looking at stop reacting what's happening. I just put my head down. We're working harder. We're adding more value. Because you know what? We can't focus on things that we can't control. You know what I mean? At the end of the day. So, of course, before you just keep hitting your head against the wall, not really understanding what's going on and, trying to react. But at the end of the day, we just do what we're doing. We offer great service to our clients. We give them great products. We give them great pricing. We get them into, home ownership. That's what we do here. And,
now, do you do FHA at 11?
Yes, sir. It's one of our strong suits.
Okay.
Government down to 550 with manual underwriting.
Okay. Two things that you mentioned right there are interesting. FICO score, how low do you go? And, of course, manual underwrite allows you to be able to, let FHA do what FHA is supposed to do, which is to help borrowers who either have a lower FICO score or are new to the marketplace and don't have 20% down or 10% down.
Listen, Jeff, I'm seeing an unprecedented amount of loans between the FICO score of 660 and 700 that you wouldn't believe are actually not getting approvals when you go Fannie Mae or Freddie Mac, which is a conventional loan. They're getting referred with caution or approved ineligible because it does not meet Fannie Mae or Freddie Mac's current acquisition preference. That's the only thing. Everything else is good. Your ratios are good. You have solid money.
Right.
You have good career, but it's giving you an ineligible finding. And then what that means, you can't really do a conventional loan. Nope. We at 11 Mortgage, we're one of the few wholesalers that will manually underwrite it, but it's a very strict guidelines compared to if you just get an agency approval. But so that's why FHA is a great option right now, not to mention they just lowered their mortgage insurance premium.
Yes, they did.
So it's the rates are lower than conventional. The cost is lower for the borrower. The monthly MI is lower, so it's a great option for your first-time home buyers, especially ones that don't have the cream of the crop,
credit score
profile.
Yeah, right.
Yeah.
Okay. Hey, listen, we're at the end of it. I'm sorry to say, I really enjoyed talking to you, as I always do. Could you give people a way by which they can get a hold of you, especially if they want to talk about a couple of these products that you've been talking about?
Of course. My direct telephone number is going to be 661-414-4730. And then you can go ahead and give me an email at Ryan, R-Y-A-N, Bagan, B-A-G-A-N, at 11mortgage.com, all spelled out.
Excellent. Ryan, thank you very much for coming on the show. Really appreciate it.
My pleasure, Jeff. It was great speaking with you.
Great.
Stay dry, okay?
Yeah, you too. That's Ryan Bagan from 11 Mortgage. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, for listening each and every week. There's been a lot of things happening both in the banking world as well as in the real estate world. We've gone through some of the information that needs to be gotten to on an earlier segment. But if you want to go to podcast world, now everybody and their brother is podcasting. Now we've been podcasting for a number of years, and we do a certain service with what we do for the show that's also placed on podcast. Do you have a list of those podcasts, Darryl?
Yeah, I might. Apple Podcast, Google Podcast, Spotify, Spreaker, Stitcher, iHeartMedia, Audacity, YouTube, Podclips.io, and of course, The Mortgage Voice.
Excellent. If you go, the Mortgage Voice is our website, and if you go there, you can hear and see and get and get in touch with those people that you've seen on the show. That's a good way to do it. The podcasting world, which I love, what we do in mortgages, very few are like this, that really lay out programs. They talk about some of the macro issues going on in the country and in the area. I want to say hey to KCAA out in the Inland Empire in Southern California, San Bernardino and Riverside counties. Been carrying the show for a number of years, but we try to deal not only locally but also nationally, and then we bring some guests on the show to talk about programs, what's happening in those specific banks, in order to give you an option of what you're thinking about if you're thinking about either purchase, selling, or refinancing. I don't know about refinance right now. We've seen rates actually go up and down like a yo-yo in the last week and a half. We were up to about 7.25% at some particular lenders, and we went all the way back down to, the low sixes, and now we're rising once again. And this all has to do with the bank failures that we're having, and maybe that is going to slow down the Fed in terms of their raising of their short-term interest rates, what they call the Fed rate. And we will see very soon. Next month, I believe, is when it is. So let's just get to a couple of other larger topics that we were talking about in the scope of what happens both in the banking world, which, when we were in 2008, 2009, everybody refers back to that as if it's ancient history, which I guess in the fast-paced world of the internet and for that generation of borrowers who came to be since that particular crisis, maybe it is ancient history. But if 15 years ago is ancient history, wow, I'm an old guy because I go back many 15 years, maybe 3, 4, 5 of them. And in that result, I can say that there are certain things that people look to when they talk about the free market system and how things are supposed to work, the bailing out of this particular bank, Silicon Valley Bank. I think most people look at Silicon Valley Bank as being something akin to, I have no idea what that is. It's almost like crypto, and that particular bank also failed, the crypto bank. What was the name of that crypto bank, Daryl? Do you have it on the top of your head?
I do not.
Okay, well, I do somewhere. Where is it?
Bitcoin?
No, the Bitcoin one is called Signature Bank. And that's a failure. That's kind of a crypto bank. And by the way, funny thing, Dodd-Frank, we referred to it earlier in the show. One of the architects of Dodd-Frank, of course, is Barney Frank. And Barney Frank from Massachusetts is on the board of directors for Signature Bank. And he came out with some lame excuse to, oh my gosh, I can't believe this happened. And this is one of the revolving things, and why so much of what we do is in my opinion, we boast about the freedoms and the fairness and the beautiful things about what this country is, and there are many. But one of the bad things is we have this rotating door between government and private sector, and it goes on and on and on, whether it's defense contractors, whether it's EPA oil executives, whether it's Dodd-Frank, where you have Barney Frank, who architected Dodd-Frank, is now on the board of directors of this Signature Bank, which was the third largest failure in U.S. history. Nice job, Barney. I really appreciate you helping us out there. So when we talk about these particular major issues, and we try to figure out exactly, okay, how does that affect me? I'm just a guy who's trying to work hard, put my money in the bank, hopefully it's safe, and then to be able to get a mortgage. How is that going to affect me? Well, it affects you in that if, in fact, the fears of more runs on banks continue and people begin to take their money out of these institutions, obviously the institutions aren't really able to lend money if people are taking money out of the bank. The deposits in of themselves aren't lent out, but they are used as the basis to go to the Treasury and borrow money at a rate of 10 to 1. So if you have $1 and you can borrow $10, but if you have 50 cents, you can only borrow $5. So it's a problem, obviously, and the requirements that are needed from the original Dodd-Frank back in 2008 in order to keep a certain liquidity in your bank. These are the things that are always being used. Now, when the Fed started raising rates in order to curb inflation, my thought was, why don't they just up the requirement of the amount of money that's needed for their liquidity, what they call the stress tests, where they'd go in and see, okay, do you have enough money? Let's say XYZ happens. Well, apparently, these particular banks that failed didn't have those particular requirements because back in 2018, they got repealed a little bit because the banking lobby is relentless, and we had a very friendly president to the banking needs, obviously, and again, another guy who's got some conflicts of interest here. You think Hunter Biden has some conflicts of interest. This guy Trump was approving banks to be able to lend more easily without the requirements needed for liquidity, and when exactly he needed that liquidity, and as we found out later, cooking the books on his own. Anyway, it's just a mess, that particular part of it, and I don't blame one party over another, but it exists, and it never stops, and it just makes me the crankiest of people, because I'm a guy who pays my taxes and kind of does the right thing most of the time. I would say 99% of the time. And some of the industries that do really not have regulation, they do, but they don't. I mean, can you say that you've been to a gas pump over the last 6 to 18 months and said, oh, yeah, this is a fair price because of market conditions? I enjoy paying this $5.60 per gallon of gas. We're still paying this. It's just in California, Southern California, anybody who buys gas or works for a living, i.e. in construction or drive truck or carpool or any of these things that needs that particular product, there's no competition in the marketplace, none. And in California, we just get hammered, and every day you go to the pump and you go, oh, this is unbelievable. Well, it's not only gasoline, it's oil itself, it's heating oil. I have a car that just burns oil. I don't know why. It's either got some leak seals or some carburetor issue, regardless. So I put probably, 1-2 quarts in every 3 months, 3.5 months, right? I should go and get it fixed, but I haven't. Man, the cost of just a quart of oil is just unbelievable. I think I paid $6.50. I remember back in the day, and I don't remember back in the day, okay, I'm an old guy. But 25, 30 cents, you could go into any gas station and get somebody to do it for you, and, for 50 cents. This is unbelievable, the amount of things that have raised that I have zero control over. Heating oil, electricity is another thing. Now, I talked about what happened with the solar industry, with the wind industry, anything that is not oil related. It has become so complex that you cannot just go out, get a battery, generate your own electricity, and do away with being hooked up to the electric company. Can't do it. You have to sell that to them, then they sell it back to you. Go figure, right? You talk about, this is like the IRS, right? You pay taxes, but then they give you the money back if it's not a certain. Why isn't that kind of a waste of money? Why don't we just figure all this out beforehand, pay them the tax that they should be paid, and that's it. Doesn't work like that. It's called payroll tax. They need to float, and they too borrow money. That's right. The federal government borrows money from the federal government. Yeah, I know. It's crazy. Let's see. Let's just get to a couple of mundane issues like the interest rates. Yes, that is kind of a mundane issue. All right. 30-year fixed rate loan at 6.75%, 15 years at 6.22%. The FHA is at 6.25, 6.20 is the jumbo, 6.59 is the 5-1 ARM. That 5-1 ARM is still greater than the 30-year, or very close to the 30-year. The 2 years at 4.23% and the 10 years at 3.64. That is narrowing the spread. Was almost a point. It's now a little over a half a point. So it's interesting, that part of it. Anyway, we've got about 30 seconds left. Bank failures equal lower Fed raise? Maybe. We'll have to see, and we'll see how this shakes out. We seem to have two different currents going at the same time, trying to kill inflation, and at the same time trying to reassure the public that their particular bank is going to be okay. Anyway, I'm Jeff Barton. This is The Mortgage Voice. Thanks very much for listening in to the show, and we'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.